All right, guys, today I prepared a little bit of an exercise. We're going to calculate these 5 metrics and we're going to talk a little bit about them more. In valuation, we're trying to assume what a company's worth based on its cash flow generating capabilities, but in the early stages of our valuation, we're just trying to see what the business itself is worth. So our EBITDA is just our EBIT plus our non-cash expenses like depreciation and amortization. This will be our apples to apples comparison metric across similar companies just to see how efficient our operations are. Different companies have different capital structures and EBITDA excludes all of that. This is purely just operations. Next is our net operating profit after taxes. Very similar to EBIT, except we're including taxes because every single business earns and spends, and there will always be some sort of tax deduction in that. So we take our EBIT and we multiply by 1 minus the tax rate. Next is our unlevered free cash flow. This is a theoretical metric that says how much cash flow from operations would be left over, assuming we had no debt. Unlevered always means before debt or excluding debt. So let's reference our NOPAT that we just calculated. Let's add back depreciation and amortization. We'll deduct capital expenditures, and we'll also deduct net working capital because it's an increase, meaning it's money tied up in things like inventory or waiting bills from customers. So if net working capital is positive, it's a cash outflow. If net working capital is negative, it's a cash inflow. So hit enter. Next, our gross profit margin is just the percentage of revenue after direct production costs. So we have revenue minus cost of goods sold divided by revenue. And finally, net profit margin is just the percentage of revenue after all sorts of expenses. So we have net income divided by revenue. Make sure it's all formatted in percentages.